Are hedge funds a fit for average investors? Joining us for this week's Smith Business Close-Up is Russ Wermers, professor of finance at the Robert H. Smith School of Business. Dr. Wermers, thank you for being with us. Let's start at the beginning on hedge funds. Just what are they?
Well, hedge funds are, Jeff, are private partnerships, generally partnerships of wealthy investors who hire a specialized, highly compensated manager for the partnership to invest their money. These are basically investment clubs, if you will, a little bit more formalized than that. Investment clubs consisting of people, generally high net worth investors who have at least $2.5 million in financial assets.
Warren Buffett famously said that hedge funds are a compensation strategy, not an investment strategy. So what do they do with the money? What is the investment strategy?
Well, they're all over the place. I think the main thing, they have long-short equity strategies where they can both go long equities like normal mutual funds do, as well as short, undesirable equities. They can do things like convertible arbitrage. If the bonds are overpriced relative to the stocks, they can buy a convertible bond and short the stock, do things like that. They can make bets on takeovers. They can short the acquirer and go long the target. All sorts of things. The sky's the limit of what they can do, and it's because they don't have to follow the regulations that govern open-end mutual funds that are sold to retail investors. So they're free to do long and short and leverage to whatever strategy that they desire.
We hear stories in the news of some spectacular successes. We also hear stories of some spectacular failures. On average, how's the performance?
Well, I think it's the compensation and the incentives are all aligned nicely for these portfolio managers. They generally get 2% per year fees on the assets under management, and they also garner 20% of the returns, as long as the returns stay above a high water mark. So this is much more compensation than they can expect if they were to manage a mutual fund, which itself is not too bad. So given that they're the highest compensated individuals, you can expect these vehicles to be some of the best performing funds in the industry, and generally they are. Although with a caveat, you have to be careful, because with this type of compensation, you get a lot of fund managers who are Me Too types, or who are the type that can say they can do special things and do not actually do that.
So how should average investors look at this?
Well, I think they should look at it with caution. I think, in general, I think there are many opportunities for the small investor now through mutual funds that employ hedge fund-like strategies. For example, AQR offers a diversified arbitrage fund that makes bets similar to what I was talking to, betting on mergers and acquisitions and on convertible bonds. American Century has an equity market neutral fund that takes long positions and short positions depending on the relative desirability of different equities. And these types of hedge fund-like mutual funds actually allow small investors to invest at minimums such as $2,500. So that being said, I think it's a good thing for individuals to look at whether they like this type of strategy, and they can even put a small amount into the strategy if they're a little bit, if they want to just get their toes wet for a while. But kind of in general, I wouldn't recommend that the average lay investor put great amounts of money in hedge fund type mutual funds.
All right, Russ Wermers is a professor of finance at the Smith School of Business. Dr. Wermers, thank you for being with us.
Thank you very much, Jeff.